Today, we're going to talk about the refinancing rate. We'll break down what it is, why it matters, how it affects loans, mortgages, the economy overall, and why central banks love changing it so much. Stick around till the end to learn how not to lose money on deposits, loans, or investments because of just one number the central bank controls. Don't forget to like the video and subscribe to the channel. The refinancing rate is like the heartbeat of the financial system. But what exactly is it? Imagine that banks are like people who constantly need money. They go to a richer friend, the central bank. That friend won't just hand out cash, they want interest in return. That interest is the refinancing rate. Commercial banks borrow money from the central bank, usually by putting up collateral, and they pay a fixed rate for it. This rate doesn't float in a vacuum. It impacts pretty much everything regular people deal with: loans, mortgages, bond yields, savings interest. All of that is tied directly to how much it costs banks to borrow from the central bank. The higher the rate, the more expensive loans get. And the harder life becomes for people who are used to borrowing. Join our Telegram channel where we post updates about new videos and articles. Links are in the description or the first comment. Here's something interesting. Banks aren't just sitting on piles of cash. In fact, they try to hold on to as little extra money as possible. The money they do have, they put to work, giving out loans, investing, running their business. To keep up the right level of liquidity, they turn to the central bank. If the rate is high, they think twice before borrowing more. That means they'll be less willing to give you a loan, especially if your income is unstable or your credit history isn't great. And that's the whole point. A high rate slows down the flow of money, which helps keep prices in check. It's the main tool central banks use to fight inflation. When prices rise too quickly, the central bank hits the brakes by raising the rate. Money becomes harder to get, demand drops, and inflation cools down. But this tool cuts both ways. Lowering the rate is the opposite. It's a way to boost the economy. When it's easier for businesses to get credit, they can open new factories, hire more people, grow. That reduces unemployment and ramps up economic activity. The risk? Inflation can take off again. Cheaper money means more demand and higher prices. Now, if you're a regular person, interest rates look like this. If you want a loan, you want a lower rate. That way you'll pay less back to the bank. But if you're saving money, you want a higher rate, so your deposit earns more. That's basic economics. Lenders love high rates, borrowers love low ones. Let's say you're thinking about getting a mortgage. The higher the rate, the more expensive your monthly payments. That might mean buying a smaller place, or not buying at all. So when rates go up, fewer people want mortgages. That lowers demand for housing, which can lead to falling property prices. And people feel poorer, not just in their wallets, but emotionally. Their home is worth less now. That hurts consumer confidence and slows the economy even more. We've got a brand new article up on our website. There you'll find free resources about stocks, bonds, and ETFs for total beginners and experienced investors alike. Check it out and bookmark it. Still, the main reason central banks make these moves is always inflation. Controlling price growth is one of their top priorities. When inflation gets out of hand, raising rates is one of the few reliable tools they've got. Making money more expensive means people and businesses spend less and inflation cools. But if they go too far, it can lead to recession. The economy sputters, investments dry up, layoffs begin, and incomes drop. So, why is managing interest rates harder than it used to be? Because the world's changed. Back in the day, the refinancing rate was pretty much the only game in town. Today, there are dozens of moving parts. Global markets, high-frequency trading algorithms, crypto, geopolitics. Just raising the rate doesn't guarantee anything anymore, and the effects might not even show up for 6, 12, even 24 months. It's like a brake with a delay. You hit it now, but you won't feel it until later. Even so, central banks still use this tool, just more carefully. They study forecasts, inflation expectations, the job market, consumer activity, and a whole bunch of other data points. They know one wrong move could crash the market, or if they don't do enough, inflation keeps eating away at people's purchasing power. Think of the refinancing rate like the body temperature of the economy. A high temperature means inflation. A low one? The economy might be going into hibernation. Keeping it just right? That's an art. No wonder people have won Nobel Prizes for theories on how to manage interest rates. Central banks play the expectations game. They want markets to believe that the rate isn't just a number, it's a clear message. If inflation's too high, the rate goes up. If the economy's struggling, it goes down. That predictability helps prevent panic and keeps things balanced. People often ask, why do central banks care so much about inflation anyway? Wouldn't rising prices mean more profit for businesses? Sounds logical at first, but inflation is like heat in a room. A little is cozy, too much is unbearable. High inflation eats up savings, kills buying power, and makes it impossible to plan. Imagine saving up for a car or an apartment, but prices rise faster than your income. After a year, your savings are worth almost nothing. That's why inflation is one of the sneakiest threats to economic stability. Picture the central bank as the driver of a massive truck on a slippery road. Their job isn't just to keep moving, but to do it smoothly. Their brake is a rate hike, their gas pedal is a rate cut. But the brakes have a delay. Hit them too hard, you skid. Wait too long, you crash. That's why every rate decision is a tightrope walk, balancing dozens of indicators: consumer demand, job data, productivity, global trade, even the mood on the stock market. Like the video and subscribe to the channel. Support our content on our membership platform. The link is in the description or the pinned comment.